Today we're unpacking one of the most fascinating economic stories of our time. We are going to dive straight into the cinematic rise, the baffling paradox, and the massive global shockwaves of Japan's economic reality. Whether you're tracking international trade, curious about global finance and the yen, or just wondering what the future might actually hold for your own country's economy, Japan is literally the ultimate case study. Let's get right into it.
So, let's start with a really mind-blowing contrast. Back in the late 1980s, Japan's wealth reached proportions that are almost hard to comprehend today. At the absolute peak of its asset bubble, it was estimated that the land under the Imperial Palace in Tokyo, we are talking an area of just 3.4 square kilometers, was worth more than all of the real estate in the entire state of California. People were genuinely predicting the exact year Japan would overtake America as the supreme global economic superpower. But fast forward to 2024, Japan didn't overtake the US. In fact, due to a heavily devalued yen, Japan actually lost its crown as the world's third largest economy to Germany.
And that devaluation brings us to an immediate crisis we're watching unfold right now, centered around the number 160. In early 2024, the Japanese yen broke through the psychological barrier of 160 to the US dollar. That is a 34-year low. And this wasn't just some minor market fluctuation, It forced the Ministry of Finance in Tokyo into historic, multi-billion-dollar currency interventions. They literally jumped in during the low-liquidity Golden Week holiday just to push the rate back down to 155. But as market analysts are quick to point out, government intervention alone, that's really just buying time.
To truly understand the macro panic causing that currency crisis today, we have to trace the timeline of what's known as the lost decades. Look at this trajectory with me. Japan's economy suffered a massive bubble burst in 1990. By 1995, its nominal GDP was sitting at $5.55 trillion. Keep that number in your head. Because by 2016, things were so stagnant that the Bank of Japan had to introduce negative interest rates. And by 2025, the nominal GDP is projected to have actually shrunk to $4.27 trillion. Over 30 years, an economy of that immense size managed to literally shrink in nominal terms, all while the rest of the developed world was growing.
Now, the core disease behind those lost decades is deflation. And honestly, on paper, deflation sounds absolutely great for you and me as shoppers. Things get cheaper every year. What's not to love? But to a central bank, deflation is a terrifying death spiral. Think about it. If your money is going to buy more next year than it does today, why would you buy a car or a fridge right now? You wouldn't. You wait. Consumers hoard cash, businesses stop investing, wages stagnate, and eventually the entire economic engine just grinds to a complete halt.
While domestic demand froze up, Japan also experienced a massive wave of deindustrialization. Remember, Japan was the undisputed king of global manufacturing in the 70s and 80s. But as domestic demand dried up and the yen fluctuated wildly over the years, Japanese firms aggressively shifted their production to other Asian nations, places like China and the ASEAN countries, just to lower costs. This systematic hollowing out of their manufacturing base left them highly vulnerable to the kinds of global supply chain shocks we've seen recently.
Which brings us to a really fascinating paradox: macro panic versus micro peace. We've just looked at some absolutely terrifying macroeconomic numbers. But if you zoom in and ask the average person living in Tokyo or Osaka today, you're going to hear a surprisingly different story, like this expat forum user who noted that life there really isn't too bad. Despite the apocalyptic economic headlines, residents report living in a highly affordable, stable, and safe society. The trains run on time, cities are clean, and housing, especially when you compare it to places like London, New York, or Sydney, is actually manageable. It's a stark contrast to the inflation-battered middle classes in a lot of other Western nations who feel like they're just constantly falling behind. But we have to be clear, this micro-peace is complicated. The domestic reality is a major double-edged sword. That exceptionally weak yen we talked about, it's created an absolute boom for foreign tourists. We're talking a record 36.87 million visitors in 2024. If you're coming in with US dollars or euros, Japan feels incredibly cheap. But simultaneously, because Japan relies so heavily on imports for its energy and food, that same weak currency completely drains the wallets of Japanese citizens. Real wages have plummeted, the price of staples like rice surged by 60% in a single year, and over 10,000 so-called zombie businesses, these are small companies basically kept on life support by cheap debt, were finally pushed into bankruptcy.
So how does this local dynamic impact the rest of the world? That leads us to the carry trade and how Japan exports its crisis.
Japan's unique domestic balancing act actually builds up into a massive interconnected risk for global financial markets. And it operates through a really clever, somewhat risky mechanism called the carry trade. Because Japan has spent decades fighting deflation, its interest rates have been parked near zero for ages. Even after some recent hikes, the main rate is barely 0.75%. So, savvy global investors do this. Step 1, borrow billions in Japanese yen almost for free. Step 2, convert those yen into US dollars. Step 3, invest those dollars in high-yield assets like US tech stocks or treasury bonds. It's virtually free money for investors, and it has pumped huge amounts of liquidity into our global markets.
But this entire global financial machine is held together by a surprisingly fragile thread. Japan currently carries a staggering government debt-to-GDP ratio of 230%. That is the highest among all developed economies. And why does this matter to you and me? Well, if the Bank of Japan aggressively raises interest rates to save the yen, two catastrophic things happen. First, the global carry trade unwinds violently, crashing international markets as investors rush to sell their assets to pay back those yen loans. Second, domestically, the Japanese government's debt servicing costs absolutely explode. They are virtually trapped.
And feeding this entire fragile financial system is a much deeper issue, the demographic time bomb.
Zooming back out from the financial markets for a second, the root cause driving this entire slow-motion crisis is something structural and deeply human. It's a hyper-aging population. And this isn't just an economic headache. The National Institute for Defense Studies officially categorizes Japan's shrinking, aging demographic as a direct threat to national security. The shrinking pool of younger individuals is severely hampering the self-defense forces' ability to even recruit, leaving the nation vulnerable in an increasingly tense geopolitical neighborhood.
And, of course, the economic ripple effects of these demographics are just immense. The IMF estimates that simply due to demographics alone, Japan's economic growth will be dragged down by 0.8 percentage points every single year for the next 4 decades. As the absolute oldest country in the world, an ever-growing chunk of public money has to be diverted away from innovation and defense and poured directly into healthcare and pensions. Meanwhile, a shrinking workforce means massive labor shortages and a significantly smaller tax base to actually pay for all of this.
Which brings us to our final and perhaps most important point: Japan as the canary in the global coal mine.
So, why does Japan's highly localized paradox matter to a viewer sitting in Europe or North America or anywhere else? Because Japan is essentially an economic time machine. They were simply the first advanced nation to hit the absolute limits of debt, an aging society, and the fundamental assumption of infinite economic growth. Look at the timeline. Japan crossed the sub-replacement fertility line way back in 1973. Today, 50% of all countries have crossed that exact same line. Japan's economic stagnation started in the 90s. Today, we're seeing widespread productivity slowdowns across the West. Japan is at 230% debt to GDP. Global public debt is surging almost everywhere right now. Japan isn't an outlier. They are just a few decades ahead of the curve.
And the global projections completely confirm that this isn't just a localized Japanese issue. By the year 2050, 75% of all countries on Earth will have sub-replacement fertility rates. The structural challenges that Japan has been wrestling with, managing a shrinking workforce, trying to spur innovation without triggering inflation, balancing explosive elder care costs, these are going to become the baseline reality for the vast majority of the developed world. Japan serves as our ultimate warning sign, but also, hopefully, the ultimate testing ground for policies like integrating AI and robotics to bridge that labor gap.
Which leaves us with this final, really striking question to end our explainer today. Our entire modern global economic system is built on the premise of infinite compounding growth. But if that infinite growth is actually a myth, is Japan's present the rest of the world's inevitable future? As the entire globe ages and debt piles up, are we all going to be forced to learn how to manage decline? Thank you so much for joining me to explore this incredibly complex topic today.